Welcome back. In this lecture, we're going to look at the standard CGE model. Last lecture, we looked at the simple CGE model where there are only two factors, two sectors, and just a household. In this lecture, we're going to build a more complicated model. By complicated, we mean more realistic by adding a government, an investment capital account, an external sector where there are imports and exports, and we will also include intermediate inputs, which didn't exist in the previous lecture. So with these characteristics, our model is a bit more realistic, and we will call this model a standard, still simple, but standard CGE model. So this standard CGE model is a general purpose CGE model, which you might want to use also in your research or in a homework. Okay, so what I'm going to ask you in this lecture is that last lecture we looked at how to input all these in GAMS programming code. So I'm going to give you the details and also some more detail, because we will have more equations and some economic theory here in the standard CGE model. And I'm going to ask you, of course I will give you the details, but I'm going to ask you to put all of these in GAMS programming using your knowledge of GAMS. So rather than showing how to do that in these slides, I'm going to ask you to do that. This is going to be your homework for this lecture. After you finish following this lecture, I'm going to ask you to send me the GAMS file, GMS file, which includes your GAMS programming code, and also the results file, which is a list file with the solution. So please take a very good look at the previous lecture 4, where most details about programming code exist, and you will need the same kind of programming and knowledge in this lecture as well. So what is good about this standard CGE model is that you can use a real-world example, a real-world SAM, such as those available on internet. You can find out about developing countries SAMs rather very easily nowadays, because a lot of researchers have made it available to other researchers online, and most often for free. So that is going to be your end term project. So that is to say, the standard CGE model you're going to learn in this lecture is going to be very useful for your end term project. So I suggest after you finish this lecture, I'm going to ask you to choose to split into groups of 2 people, and I want you to work in groups, and I will give you SAMs which you will be using to write your end term report. So the standard model is going to be the model you're going to apply in your end term project, and I will make sure that the SAM, because SAM can come in different forms with different levels of aggregation and disaggregation, but I'm going to make sure that the standard model we use, the standard CGE model, and the standard the SAM for this model we use in this lecture is going to be the same as the SAM you're going to get in your end-term project. So having said that, let's move on to the structure of this standard CGE model. We will start first by introducing the new social accounting matrix SAM in the next slide. Here's our new social accounting matrix. This social accounting matrix is a bit more sophisticated and detailed than the previous SAM we used. And remember, the previous SAM had only bread, milk, capital, labor, and households. But these are actually the first five items here on this same SAM you see here. Bread, milk, capital, labor, and households. Bread and milk are two industries, so we still have two sectors in this economy, bread and milk. We have two factors of production, capital and labor. Now we have more institutions, I mean more actors in this economy. So we have one household, HOH. We have a government, GOV. We have an investment account, INV. This is, remember, this is the um, investment agency, the virtual investment agency we were talking about in earlier lectures, where we take account of investment and saving data. Okay, and then we have two new accounts, which are actually related to government, but we prefer to keep them aside for convenience as separate entities. The first one of these is IDT, which is indirect taxes, and the second one is TRF, tariffs. Indirect taxes are something like production taxes. So for example, the producers are paying to the government uh, for the production activities. You know, they have to pay some taxes on this, and these are indirect taxes. And then there is the external sector. External sector is most often referred to as the rest of the world account, and the short notation or abbreviation of the rest of the world is ROW, rest of the world. We prefer to use external in this case. So let's have a look at these numbers. In the previous lecture, we didn't have intermediate inputs, remember. So that's why the bread and milk rows and bread and milk columns. Actually, this is the top left corner of the SAM matrix here. It was blank in the previous SAM. Now we have intermediate inputs. If you look at these numbers, you'll see 42, 16, 34, and 18, which means, so remember that columns in the SAM means payments and rows means receipts. So bread sector is paying 42 yen to bread sector for use of intermediate inputs. And milk sector is paying 16 yen to bread sector for the intermediate input use. So if you look at the bread sector now is paying 34 bread sector column. Bread sector is paying 34 yen to milk sector because they are using inputs milk as input in production, and the milk sector is using 18 yen worth of milk in production. So an industry can use its own output as input. In this case, 42 and 18 are belong to the same input, same industries. They use their own output as input, which is possible. And then when you look down on bread and milk sectors, you will see that they are both paying 40 yen, which is interestingly equal here. They are both paying 40 yen to capital, and bread is paying 30 yen, milk is paying 70 yen to labor. So payments to capital is basically something like profits, because this capital belongs to whole owners of capital. Well, in this case, it is basically households. And then labor. In the labor row, you see 30 and 70. These are basically industries. Bread industry is paying 30, milk industry is paying 70 to labor, which means they are paying. So these are wages. And if you look a bit more down, then you will see two numbers. The bread sector is paying 10 yen and milk sector is paying 8 yen as indirect taxes. So the producers here are paying this much in these sectors to the government as indirect taxes. And you will see also 2 and 4 as tariffs. These are payments. These are actually, tariff is a tax on imports. And the bread sector is paying 2 yen for imported bread. So we have now an open economy, and we are importing bread from abroad, and we are paying 2 yen as tax on these imports. And then there's the milk industry. For the import of milk, we're paying 4 yen as tariffs or import taxes. Okay, where do we see imports of bread and milk? It is the last row, external account. If you look at the external account, you will see that there's 26 yen worth of bread imports and 22 yen worth of milk imports. So we're importing both of these products and the numbers are appearing in the last row. Okay, bread industry is paying 26 to external, so which means external means foreigners. So that means these foreigners are actually receiving 26 yen from bread industry. That means these are imports, and similarly for milk, 22 yen of imports. If you look at the cap and lab rows, cap and lab columns, you will see that households are receiving the for this provision of capital services, they are receiving 100 yen. This is for labor they are receiving 80 yen. And basically, these are payments to factors of production made to households. Okay, and then if you look at the household column on the next column, you will see that households are paying 40 yen for consumption of bread, 60 yen for consumption of milk, and then households are paying, and look at the same column, but at the bottom you will see that households are paying 46 yen to the government. So households are paying to the government. Basically, these are taxes. So households are paying income tax to the government in the amount of 46 yen, and households are also saving. So household savings are going to the investment account, INV. The INV row and households column, you will see that households are saving 34 yen out of their income. And we look at the government is also paying, spending money on goods and services. So we have 38 yen of government spending on bread and 28 yen government spending on milk. And then the government is also saving. In this case, we have 4 yen. But this is a very nice case because it is positive, which means the government is saving by 4 yen. The saving means income minus spending. So government income minus government spending is government savings. This is similar to saying budget surplus. So in this case, the government has 4 yen of budget surplus. Okay, and then next column is INV, investment column. Then you will see that the bread and milk sectors are investing. So investments in bread sector is 32 yen, and the investments in milk sector is 30 yen. And this is the only number you see in this column. Finally, there is the IDT account. Remember that IDT is the indirect taxes, and taxes are revenues for the government. So revenues or receipts are on the row. So we have to put this in the government row. And the government row, IDT column, you see 18. Similarly, tariff revenues, import taxes go to the government as well. And you see 6 in the government row and tariff column. And the last column is the external account. And external account is paying bread and milk. So this is foreigners paying to bread industry and milk industry. Bread and milk row and external column, you will see these 16 and 8. 16, so because foreigners are paying to domestic industries bread and milk, this means we are receiving payment from the government for our products, which means exports. So bread exports are worth 16 yen and milk exports are worth 8 yen. And finally, there is this number 24 in the investment row and external column. So these are just like government and households, foreigners or external account are also saving. These are foreign savings. 24. 24 is basically the foreign savings in this case. So positive foreign savings mean that foreigners are actually paying to the investment account. This is something like our savings. Actually, it's not our money. It's coming from abroad, but we are receiving it from abroad. So how do you receive foreigners' money? Well, in many ways. This can be uh, through borrowing. You can be borrowing from abroad. This can be through, and borrowers can be private firms, can be government. Many different ways you can borrow from abroad, or you can be receiving some sort of grants. Some, very highly indebted poor countries receive grants from other countries, developed countries, and well, this might also appear in this cell 24. Okay, so this is what I can say about columns. Remember, the column sums and row sums have meanings. If you look at the bread, and I didn't put total figures here, which you're free to do on your own. If you look at the bread and milk industry columns, the column sums will be equal to the total amount of output. For capital and labor columns, the column sums will be equal to total capital and total labor outlays. And for household account, total the total of household, the column sum is going to be equal to total household outlays, and similarly for government. And for investment, the column sum will be equal to total investments in this economy. IDT and TRF column sums, well, there's only one number here. It's going to be total indirect taxes and total tariff payments. Finally, for the external account, you will see the total column sum will be equal to, because this is equal to exports plus foreign savings. This is something similar to foreign exchange earnings in total, because exports are earning foreign exchange, and we are also using foreign savings, which is borrowing. So this is also income in terms of foreign exchange. So the column sum for external account is going to be total foreign exchange earnings. And as for rows, bread and milk rows, if you look at bread and milk, you will see that this is equal to total. Well, these are equal to intermediate inputs plus household consumption plus government consumption plus investment plus exports. But this is basically the total supply in bread and milk industries. If you look at cap and lab rows, these are basically total capital income, on total payments, total receipts for capital, and total receipts for labor, or total profits, or total wages, if you wish, for the row sums. For household sum, it is the combination of capital and labor income, which means total household income in this case. This is the row sum for household. For government row, the sum is going to be equal to total government receipts, or total government revenues. This is made up of government savings plus indirect taxes plus total tariff revenues. Okay, these are basically the revenue items for the government. I think okay, made a mistake. Yeah, for government, actually, the revenues are coming from taxes. No, not savings. So the government row is going to be 46 plus 18 plus 6, which means households are paying income tax to the government. Then there are two other tax items here: indirect taxes and tariffs. So basically, this is total tax revenues, or total revenues of the government. Okay, and for investment account, you will see that on the row side, investment row, you will see 34 plus 4 plus 24. Remember, these are household savings plus government savings plus foreign savings. So these are total savings in the economy. For the IDT and TRF, you will see that these are equal to total indirect tax. This is on and total indirect total tariff taxes. Okay, and for the EXT, external sector, the sum of 26 and 22 are actually, we have no other numbers here. These are total imports. So basically this is equal to total foreign exchange payments abroad. Okay, so there are some relations here which are very important to understand the macroeconomics of this SEM. For example, if you look at the external account, the total imports are 26 plus 22, which is 48. Okay, so 48. How do you pay for these imports? Well, you need to have foreign currency. So you have export revenues, which brings you some foreign exchange earnings, plus borrowing. Because if you do not have enough foreign exchange revenue, you have to borrow from abroad. So if you look at that, this is equal to saying that 26 plus 22, which is total foreign exchange payments, total imports, which is 48, is equal to, it must be equal to total exports, which is 16 plus 8, which is 24, but we have 48 yen of imports and only 24 yen of export revenues. So then the remaining part, 24 yen, 48 minus 24, 24 yen, you have to borrow from abroad. This is the foreign exchange you need to fill in the gap. Okay, and for well, if you look at the, for example, household sector again, household revenues, total household income is equal to capital and labor payments made to households, which is 180, which is 100 plus 80 here. That is the total row sum for household account. What do households do with this income? Well, first of all, they spend on goods, which is bread and milk. So the sum of these is 40 plus 60, which is 100. And then they pay tax to the government in the amount of 46. And also the remaining part, okay, they pay tax to the government. They spend some on bread and milk. And now they are left with the surplus. This surplus is their savings. Okay, so now they have 180 yen income, and they spend 100 on bread and milk goods, and they pay 46 yen to the government, and the remainder is 34 yen, which is their savings. Similarly for government, the government has an income of taxes. So it's if you look at the row, government row account, you will see 46 plus 18 plus 6, which is equal to 70. And 70 is total government income, and the government is spending this income on goods and saving the rest. And 70 is total government income. If you look at the government spending, you will see that the government spending 38 on bread, 28 on milk, which makes up 66. But the government has 70 yen of income, spending 66. The remaining 4 is its government saving. So 4 is the government saving or the budget surplus. So this is how you evaluate all these numbers here. And these are not only numbers, as we see, there are some important relationships between all these accounts, all these numbers. Okay, what we just did by looking at the numbers in the SAM is a very simple economic analysis. We now understand the structure of this economy, but only looking at these numbers. So we just took a snapshot of the economy. This is a very nice picture of the economy in the form of a SAM. But what we don't see here is how these actors, government, households, firms, industries, and foreigners are behaving. For that, we need the CGE model, and we need to model this economy using our knowledge of economic theory. That's what we do in CGE modeling. And we have to put some linear or nonlinear relationships. Some of these relationships between different actors and the behavior of the actors are going to be nonlinear, because the economy is not linear. There are nonlinear relationships, which means sometimes you have to think of what we call elasticities and things like that. We covered that in the last lecture. You saw that We have some exponents, we have some parameters. These are all equivalent to saying that we have a nonlinear relationship system in this economy. So from now on, what we're going to do is to look at the structure of the SAM and now put it in a form so that economic theory can replicate this SAM using a system of equations, and this system of equations will include will be called this computable general equilibrium, or CGE model. Okay, so what is new in this CGE model is probably not only the government and the external sectors only, but we also have intermediate inputs. We didn't have that before. In the previous simple SAM in lecture 4, we had only labor and capital used in production, but now we are using outputs of other sectors, and we are using inputs now in production. It complicates it a bit. So we will look at the structure of the model by first depicting the model itself, and it is always a good idea to look at the general structure of the model using a figure like we will see in the next slide. So we will move on to the next slide and first overview our standard CGE model graphically. Then we will step by step, just like we did before, introduce how to model each of these functional forms you see in the CGE model. Okay, so the SAM is going to be our database, and we will refer to these numbers in GAMS as well. So we will extract our data from the SAM. Then this is the SAM we will use in the CGE model. This is what our CGE model looks like. So there are different layers, and each of these layers are going to be very important for us to understand. So let's look at this picture here, which is from your textbook, page 88. If you understand this figure, then you will have a better understanding of what we're doing, what we're trying to do in this CGE model. So let's start with the bottom layer. You see that firms are using two factors, which is capital and labor. They are using these two factors, and they're creating what we call a composite factor. So the composite factor is basically the resources used in production, and the function they are using to produce this composite factor is called Cobb-Douglas production function, which we saw in the previous lecture. So now they are using capital and labor to produce this composite factor, which is the second layer, and they are combining these this composite factor with inputs they are buying from other sectors. So we are talking about bread and milk sectors here. So bread is using input from bread is using input from milk sectors, and similarly for the other sector, milk as well. So what they do is they're combining capital labor, which is composite factor, and the intermediate inputs to produce what we call a domestic output. We will call this gross domestic output. So to combine the composite factor and the intermediate inputs, they are using what we call a Leontief production function. Okay, and then now we're at the third layer. In the third layer, we have the gross domestic output. This is the output produced in the economy now, which basically corresponds to the column sums of bread and milk sectors. So that is the total output. So what do these firms, producers, do this output? So they have to sell it in the market. Okay, but which markets are these? First of all, they sell in the domestic market, and then they also sell in the foreign markets. The part they sell in foreign markets is called exports. So the remaining part they sell in the domestic market, they are domestic goods. So for the producers, the output is now sold in or transformed into exports and domestic goods. We have a transformation function for this. We will name it CET. All details will be explained later. And now we have domestic goods sold in domestic markets, but remember we are also importing the same things, bread and milk from abroad as well. These are imports. So this is a concern for consumers. So on the consumption or demand side, now we have consumers who are now combining domestic goods and imports for their own consumption purposes. And we will call that combination of imports and domestic goods. These are for both goods, imports and domestic goods of bread and imports and domestic goods of milk. So the consumers are going to combine this using what we call a composite good production function, or CES. We will talk about the details later. We call it composite good. So composite good is what the consumers consume. Remember, what the producers produce is named gross domestic output. What consumers consume is called composite good. Composite good and gross domestic output, they don't mean the same thing. Because what the producers are producing and what the consumers are consuming doesn't have to be, they don't have to be the same thing, because consumers have the choice to buy from abroad as well, and output producers also have the option of selling to foreign consumers in the form of exports as well. So that's why they don't mean gross domestic output and composite good are not the same thing. So that is the fifth layer, composite good. And if you look at the final layer, then you will see that this composite good is actually consumed. We said consumers are consuming this, right? But who are these consumers? Basically, these consumers are foreigners, firms can be consumers, government, and households. So then there are different sources of consumption or different sources of demand, and these are household consumption, government consumption, investment by firms, and also firms are using this in the form of intermediate inputs. So then this composite good is basically divided into household consumption, government consumption, investment, and intermediate inputs. So then in the last stage, you will see that the households are also achieving utility from consumption of from consumption of milk and bread. So this consumption is related with household consumption. So what the households are doing is they want to maximize their utility. So utility maximization is about welfare, but utility maximization is about more consumption of bread, more consumption of milk. So because there are no other products in this sector, only bread and milk, people will feel their welfare has increased if they can consume more bread and more milk. So what maximizes the consumption of households, consumption of bread and milk also maximizes their welfare. So that's why we have the utility function. Our utility function is of Cobb-Douglas type. Again, this is the same thing we saw last time in the previous lecture. So this is pretty much what the general structure of the model looks like. And verbally, we can say that there are links between all these, and they are connected through algebraic equations. We will be looking at them starting from the next slide, but your major task is to put all these in GAMS in the form of programming code. So you will see that what we see as consumption, output, demand, supply, all of these, they are not independent of each other. you see the arrows, you see the lines connecting all these. So they are actually linked with each other. And not everything is linked with everything else, but there are links between some of these, what we call, these are all variables that we are interested in. Consumption, spending, investment, imports, exports, output, capital, labor, these are all the what we call endogenous variables, the variables of our system of equations, or the variables in our model. So you see that these are all, most of these are interrelated with each other, especially if you look at the intermediate inputs, for example. If intermediate inputs appear in the production function, I mean, if you look at the gross domestic output, is a combination of composite factor, which includes capital and labor, and intermediate inputs. But intermediate inputs also is part of the composite good as well. So this is part of firms' consumption, firm spending. So these are all related, and what the CGE model does is to put it in a systematic, to put it all this in a systematic form to achieve a general equilibrium. And our target objective is to maximize what you see at the top of this system, which is utility. So we want to maximize utility in this model. But the behavior of all actors, households, firms, the government, they all have their own rules of behavior. So these rules of behavior are actually are based on our economic knowledge of our economic theory. For firms, we know that they exist for the purpose of profit maximization. For consumption, for consumers, it is utility maximization, which we have in the utility function here. And for for the government, we have that the government also has limitations on limited resources and also the balance between spending and income. So all actors you see here, firms, government, households, and the foreigners as well, they have this limited resources, limited income, and their spending and income are in such a relationship that if the income is not sufficient, then they can borrow, or if their spending is less than their income, they are saving. So these are new in CG modeling for us, and we have to put all this knowledge into algebraic forms, and from this point on, we're going to do that, and you will do that in GAMS. For a starter, in writing your GAMS code, you might want to define your sets as we do here in the slide. Sets U is for symmetries, as we did last time. And we have all row and column headings here. Bread, milk, capital, labor, households, government investment, indirect taxes, tariffs, and external account. And you might want to create subset for sectors or goods. There are two sectors here, bread and milk. Remember, these are for simplicity. And we have also factors of production, cap, and lab. You will remember that we need these subsets because they are very. It is very convenient to define them this way because they appear as sub-indexes in our equations, as you know from last lecture. And it's always a good idea to create a subset. Otherwise, you have to write all the time, separate for cap, separate for lab, separate for bread, separate for milk. And you don't want to do that because writing in this form of sub-indexes makes it very, very easy for us and to proceed in coding. And don't forget to create aliases because every row also appears as a column in the SAM. U, V, IJ, and HK is the way to do that. So this is the only help you will get from me in writing your GAMS code, and please use these and proceed accordingly. Okay, after you define your sets, now you have to provide the benchmark data to GAMS. But remember, we were doing that using table command, and we are going to name our table again SAM. So don't forget to define or declare your table, which is SAM over the set UV. All right, so U is going to be your rows and V is going to be your columns, and um, and the sum you see in slide number 3, put all these numbers and align them very well so that GAMS can read it. Remember that you have to align them to the left under the respective column so that it looks nice. Um, just one thing here is probably about the IDT and TRF accounts. The IDT account is indirect taxes and TRF is tariffs, import taxes. So these are basically part of government revenues, and we already have a government account, and you might wonder why we do this, so why we have separate tax accounts. Well, only for simplicity, because the indirect taxes and also the tariffs are going to be used in calculating some parameters in the CGE model. So what we do here is, and we will remember in the CGE model, we also provide the benchmark data. And we will use these parameters also as initial values of the variables later on. So what we do here is, because we have to extract this data from the SAM later on, what we want to do here is basically make it more convenient for us to find those data. And we have these two artificial accounts, IDT and TRF, just only for that purpose, as these accounts exist only for the reason that we want to be able to map them later on when we are providing benchmark data. Okay, having said that, now you can take a look at the other initial variables or initial values or the benchmark data we're going to use. Remember, the data we're going to use are the benchmark data we're going to use are parameters. So these parameters are two kinds. One is the coefficients that appear in the equation list, and the other one is basically the initial values we are obtaining from the SAM. And we will remember that we are using the same label for variables that we, for example, for consumption, we used X in the equations. But to initially, because we want to give initial values to GAMS so that it can start calculating the equilibrium values, as you remember from last lecture. The initial values we will get from the SAM, and because we already have those information in the SAM, consumption, investment, all of them are already something we know. Okay, so the GAMS or the CG model is just replicating it using the equations. So just to be able to do that, we want to use the label as we use in for variables. For example, when we denote household consumption by X, maybe for those values of household consumption in the SAM, we will use X0. X0 is just a parameter, and we will just use those for convenience. Otherwise, you have to put them as numbers in the GAMS programming code. So it is always a good idea to refer to the table you named as GAMS. You named as SAM. It is always a good idea to refer to the SAM and ask GAMS, the software, to get the data, fetch the data from the table. So this is very important in providing benchmark data for purposes of convenience. Here in this slide, we provide the benchmark parameters which we will be needing in the programming code. So those ending with 0 are basically the values from the SAM. And here you can see in the first column the parameter names as they appear in the equations, and you might want to use the same labels in programming. And all these subsets or sub-indexes are also the information which you might need in putting these in GAMS, because, for example, if you want to define y0, which is the aggregated factor account, then y0, in writing GAMS code for this, you have to write y0 in brackets I. You have to define it over the sector, over the set subset I. Okay, is equal to SAM brackets and the relevant location in the table which you named SAM. So you know how to get this data from the SAM, and if you find any difficulty, you can send me an email, so I will help you. But the calculation or the SAM location is shown in the last column. So here it shows you how to calculate all these. Sometimes you have to find where it is in the SAM, so you have to locate it in the SAM, write the location. So we do that by writing, for example, for XP0. XP0 is household consumption by sectors. So XP0 is going to be defined in GAMS as follows: XP0 brackets I is equal to SAM in brackets I, comma, households, HOH. So, and don't forget to put semicolon. Okay, this is what you will write for household consumption. And if you look at the explanation on calculation or SAM location for XP0, you will see that it's household consumption in the SAM. So you know how to find it. It is the household column and the industries or activities account, milk and bread account row. So milk and bread row is I, and the household column is HOH. So all you have to write is XP0 is XP0 in brackets I is equal to SAM, which is the name of the table you have just written in GAMS, and this is equal to SAM in brackets I household. And don't forget, because we haven't defined household as a subset, it is an element in our SAM. It is an element of U, which is the items in the row and column items in the SAM. Don't forget to put HOH households in quotation mark. Okay, so similarly for investment, for other external account EXT, for all elements you have not defined as a subset in the slide number 5, actually you declared your sets. If you don't have any subsets, then you have to put all elements other than I and H. You have to put everything else in quotation marks. Okay, don't forget that. So I'm going to ask you to use the information here in calculation or SAM location. For example, if you look at PWE, PWM, all I'm going to ask you is to put this as equal to 1. You know how to write this. And some calculations are already here. For example, tau Z, tau M. These are indirect tax rates and import tariff rates. And these are explained in the calculations already explained there. And you will have to just put it in the same formula. Okay, we will look at each of these later one by one. So let us move on to the next slide, where we will look at how to calibrate or how to initialize the benchmark data. Our system of equations is running on a set of parameters which are very important because they determine the behavior of our equations, or simply our actors in the economy. So it is important at this stage to declare those parameters and tell GAMS how to calculate them. For that, we need to specify them from the equations. Sometimes these are very easy to get, because if you look at the list of equations in your textbook and here in this previous slide, some of them are easy to calculate because, for example, we we equate the prices to 1, as we usually do in GAMS CG modeling. But some of them, which we denote in Greek letters and small letters in the equations, especially in these production functions and remember the shift and scale parameters and distribution parameters. So these are obtained using by solving those equations for those specific parameters. For example, if there is if you see a parameter alpha in the production function, all you have to do is explain this alpha in terms of everything else in that equation. So you get some, instead of something like Q equals alpha times blah blah blah, you get you have to recalculate, rearrange the equation to find that alpha is equal to blah blah blah. So then you're going to put those in GAMS and ask GAMS to calculate it for you. And in calculating that, most of the data we need are in the most of the parameters to calculate. Most of the data we need to calculate the parameters are obtained from the SAM. So this process, I mean, calculating the necessary parameters in GAMS modeling, those parameters are usually denoted by Greek letters, alpha, beta, gamma, and also small letters in English alphabet. So we don't know them from the SAM. We know consumption, we know savings, we know investments, we know exports, imports, intermediate inputs, all these. But what SAM doesn't tell us is these parameters which are important, which are the coefficients we need to put in the equations. And we get that from the mathematical formulas or just algebraic forms of these functions we are using. So the only way for us to calculate these is using these mathematical identities or mathematical equations. So this process is called calibration. Calibration is basically arranging your model to work in such a way that you calculate the necessary coefficients, which we call parameters. So this process of calibration is very important. That's why we do it before writing our equations and variables. We do the calibration. And for calibration, first you have to input the parameters. You have to declare parameters, define them in GAMS, and then you have to calculate them. Okay, so what you can take from SAM, just use the necessary coding so that you can get data from the SAM. For other parameters, do the calculations. The previous slide gives you some idea about how to do that. So that's the first step for calibration. After calibration, we need to declare and define our variables and equations in the model. So that's the step before declaring the model and solving it. So here I would like to remind you the structure of the model, what kind of production and supply and demand process we have in this model. So we have a nested production function. Nested production function means that production comes in stages. And these stages are shown in the first two levels, the bottom two levels. In slide number 4, you can see a figure there showing the structure of the model. So basically what we do is we model every stage of production in using different production functions. We are doing that because the relationships between these is the relationships between resources and how they are used in production process is different at each stage. For example, at the lowest level, you will see that there's a Douglas production function between capital and labor. So what producers do is they take that capital and labor in their production process and they create what we call a value added. So value added is the firm's contribution to the production process. For example, if you're producing bread. In this case, you use some. So in our model, we have one or two industry, bread and milk. So if you're producing bread, you might be using some inputs for some products coming from the bread industry and some products coming from the milk industry as inputs. Okay, so you use these inputs and then you make your workers and you make your machines work. You employ your workers and machines to produce the bread if you're in the bread industry. So what your machines and what your workers do in this case is they contribute to production process by providing their capital and labor services. So the Douglas production function shows this technology. Remember, technology is the way we organize our resources in production process. So what we do here is we take capital and we take labor in certain amounts and use them in the production function. So production function is a production process. But when we use capital and labor, we look at a couple of things when we decide how much capital and how much labor we're going to use. Okay, so one thing we care about in this as producers, one thing we care about is that we look at the prices of these factors, capital and labor. So the price of capital is wage, the price of capital rental rate, and the price of labor is wage. So rental rate and wage rate determine how much labor and capital we're going to use in production. So that is to say, these are some important requirements for us in the production process. That means we have to get it from the production function. Because we are doing algebra here, we're driving all this from algebraic forms. What we do here in this case is we have to get the optimum amount of capital and labor. By optimum in economics, we mean taking derivatives. Okay, so you don't take derivatives in GAMS. You do it by hand, and you find the optimum amount of capital and labor, and how to find them using the equations we have. So you put them in GAMS. Okay, so GAMS doesn't know the economic theory. GAMS knows only what we teach it. So the amount of capital and labor we use in production comes from our knowledge of economics. That's when you use your knowledge of economics. Okay, this is for Douglas production function. And by the way, when I say you use your knowledge of economic theory, this is already set. So economic theory is there in the textbook, and um, you don't need to create a theory on your own. So that means these are standard. And once you know what they mean, you can use the standard knowledge of economic theory and standard modeling, program coding in GAMS. You can use it in the future modeling exercises as well, especially in your homework. So that is the production function for capital and labor. Okay, in the next stage, we use this value added, and we now add on top of this capital and labor we're using. Now we add inputs from other sectors. Okay, so these are coming from the intermediate. These intermediate inputs are coming from other sectors in the economy. So we have another production function for that, which we call Leontief aggregation function. Okay, we're going to talk about the details of all these functions in the coming slides. Okay, then remember that we are, as producers, we have an opportunity to substitute between selling domestically or exporting them. And for that, we have another function. So what we mean substitution means we can decide how much to sell domestically or how much to export. Basically, we look at their prices. If export prices are increasing, we might want to export more to earn more revenues. Okay, so this is for the producers, their opportunity of substitution between domestic sales and exports. Similarly, from the demand side, we have constant elasticity. This is called, by the way, constant elasticity of transformation. Similarly, for consumers, now consumers can substitute imports with domestic products. Okay, so when domestic products are cheaper, they will be willing to spend more on domestic products, and when they are more expensive compared to imports, they will probably prefer to spend more of their income on imported goods, which are now cheaper. So this is called the composite good, imports and exports, so imports and domestic goods combined for consumers on the demand side. This is called the composite good. We will have another function denoting the substitution relations. Substitution in economic theory is very important. Without substitution, uh, well, we cannot really think of an economic theory. So, how to show the substitution in the economic, so in CG model in mathematical formulas? Well, this is why we need these equations and algebraic functions that we have in this CG model. I know that they look very ugly, but they're coming from economic theory, and CG is just an application of this. You might prefer to use only mathematical formulas. There are a lot of papers doing that, but CG model is numerical. So that's why we need a program software like GAMS, and we get the results in numerical form, in the form of numbers, rather than working with abstract mathematical notations. So having said that, now we are ready to look at these production functions at each stage. We will start with the Cobb-Douglas production function, and I will, in each slide, I will present you now. These are coming from your textbook. I will present in each stage, in each slide, the mathematical formulas, but I will not going to explain the maths behind it. I will rather explain the economic theory behind it, and all the derivations, taking the derivatives, optimal amounts, they are all explained in the slides. I will briefly talk about them, but I will spend more time explaining what they mean in terms of economic theory. So let's move on to Cobb-Douglas production function. We start with the Cobb-Douglas production function. The general notation for Cobb-Douglas production function is the equation you see on top. There's a product sign, but to write it in open form, you might want to look at this second equation at the bottom. Basically, F is the factor used in production. These are two, capital and labor. You can name them K and L. And Bj is the shift factor, and beta, the Greek letter beta, these are basically shares of capital and labor in total output cost. So this is a general production function used frequently in economics by researchers. And this is a specification about how the quantity of output or production behaves as a function of capital and labor, which are the inputs used in production. Basically, by production, we mean value added here. So you can apply this to the individual firm, individual industry, or to the entire economy. So because we are doing here macroeconomics, we will just assume, we will consider that we are here dealing with the aggregate production function at the economy level. So this is the economy-wide Cobb-Douglas production function then. Okay, there are so many mathematical forms of production functions. We chose this one, and a general notation is at the top here, the product. Remember, this is a product function. The big pi operator there is product operator, and the Cobb-Douglas production function looks like what you see on the left. This figure shows you the function, the same function, but in geometric form. So we have two factors, capital and labor. Capital is on the vertical axis and labor is on the horizontal axis. And the relation between capital and labor in production of output is shown by this solid line. This is the Cobb-Douglas production function, which is downward sloping. And the implication here is that you have options, and on the Cobb-Douglas production function, the amount of output is the same. To produce the same amount of output, you can use different combinations of capital and labor. For example, this can be in the bread industry. For example, if you're producing 400 loaves of bread here, then this line here, the solid line here, shows you basically how to use capital and labor to produce 400 loaves of bread. Okay, so to produce that, you might want to use a lot of capital but and little labor, which makes your production process more capital intensive. That is to the far left, upper left part of the production function. This is an opportunity. This is an option. So an alternative would be using a lot of labor and not much capital. So you may be using so many workers but few machines. That is the bottom right part of the Cobb-Douglas production function. So you can use also any combination lying in between these two extremes as well. Okay, so how much capital, how much labor we choose? We have now a lot of options for capital and labor. Use these combinations. But which one do we prefer? Actually, which one of these combinations we prefer is based on what we call the slope of this line. The slope of this line is equal to the wage rental ratio. This is the factor price ratio. Wage is the price of labor and rental ratio is the price of capital. Basically, you have a limited budget. Production is done by using your budget. And when using your budget, you look at the prices of these factors, capital and labor, and assuming that the price of labor and the price of capital is fixed in this economy. So the more workers you get, the more you pay, but the wages you pay per person is going to be the same, similar for capital as well. And the slope you see here, W over R ratio, determines how much capital and how much labor you're going to use in production. Okay, this is a particularly important aspect of the production function. Okay, so basically when we take derivatives of this production function y, j, with respect to capital and with respect to labor, we call them the marginal product of capital and marginal product of labor. So you can take derivative of yj with respect to both k and both l. Take derivative, first derivative with respect to k, you get marginal product of capital. And the economic theory says that you want to employ capital up to the point where this is equal to the rental rate of ratio. So the more capital you use in production, you want to make sure that because you're paying to capital, so the more you use, you want to make sure that because you're paying to capital, its contribution to output is at least as much as you pay. If the contribution to output, if the contribution of new capital you employ to output is less than what you're paying it, then basically you're making a loss. So on the opposite side, if you're making payment to capital and you're getting a lot more than that as contribution to output, then you might want to continue employing more capital because because you're getting more output per capital used per unit capital used. So similar story for labor. If you take derivative of this production function with respect to labor, you get marginal product of labor. So then marginal product of labor is going to be equal to the wage. And the same story like in capital. If you are employing one more worker, one more labor, and you're looking at that person's contribution to output. If the new worker's contribution to output, this is the increase in output resulting from the employment of that one labor. So the word marginal means adding one more unit in this case. So that one worker, if the worker contributes more to output, then you're paying him or her. So if you're paying, for example, 100 yen per hour, but the worker is earning you because the worker is working and producing, adding to your production. So if the added production by this worker is 150 yen. That means you're paying this worker 100 and getting in return 150. So there's a 50 yen surplus, which is basically the additional output arising from that. So then you might want to employ another worker. So the general idea is that adding too much work, too much labor, too much capital in the production process is not as profitable as before. So there will be a point where you will realize that for example, adding one more worker, paying him 100 yen, your output increases only by 100 yen. So that is the point where you stop hiring more labor. So that means marginal product of labor, which is the additional output by after you receive by hiring that additional worker, is going to be equal to the wage. And similarly for capital, that means so the meaning of slope is that. So the W over R ratio here it is shown as the dashed line. That is the slope. The slope of this line, straight line, is already known because it's a line. It is a constant slope. What we don't know is the intersection point between the production function, the solid line, and the dashed line, which is the relative wage rental ratio. So we need mathematics, we need arithmetics to calculate this, and what we do is we equate we calculate the marginal product of capital, marginal product of labor, and that's how we find the optimal amounts of labor and capital to be used in production. So that is what is so important. This is what's so important about Cobb-Douglas production function. And the next slide, you will see how we put them in GAMS. There are two formulas there. There are two equations. The first equation is going to be the production function. The second equation shows you the optimal amount of factors, capital and labor, derived from the first order conditions. So I'm not going to go into details of first order conditions here, but your textbook, if you look at your textbook from pages 66 to 68, you will find enough explanations. You're advised to look at your textbook. Actually, I copied that those expressions there and put it in the next slide as well, but you might want to refer to the textbook for more for the details. We continue Cobb-Douglas production function here. The first two equations you see here are, as I mentioned, the Cobb-Douglas production function, its general notation, and the optimal amounts of factors as we calculated. So using the equations in your textbook in the chapter 5 about calibration and computational strategy, you will see that to calculate the Cobb-Douglas production function in the CGE equations part, you need to input some parameters. These parameters are shown with 0 as superscripts, you see. So you have to define them, and you have to calculate them as they appear in the bottom half of the slide here. So there's only one difference because it's coming from an earlier simple CGE model. They used a different notation for output, which was Z. Now we are not using Z anymore. We use the capital Y. So replace all Z terms in these equations in the second, in the bottom half of the slide with Y, and you will be calculating the required parameters. So Y0, F0, these are all available from the SAM. because y0 is going to be total output. Remember, this is the column sum for bread and milk, because we have defined the output over the set of industries. J is bread and milk here, and we have F sub H. H is capital and labor, so you can get this also from the SAM easily. Just look at the factors, capital and labor rows, and industries, which is bread and milk columns. You can get this data from there as well. Using these, you can calculate beta H and the B parameters. So these are on the right side of the second half, or the bottom half of the slides here. So you can see that you can calculate the share parameters, which are beta hj parameters using this formula here, and then you can calculate the shift parameter bj using the formula on the rightmost part of this second bottom half of the slide. And finally, at the very bottom, you see there's an equation, which is P0 times Z is PZ0 times Z0 is equal to summation of PHF times FH0. So basically, this means that now we are replacing Z with Y. So basically, this means that P times Y is equal to the P is the is the price of output, price level of output, times the quantity of output. This is basically the left side of this equation means the value of output, which is equal to the P sub H and the superscript F times F sub H superscript 0. You will see that this multiplication and then summing over H. H is the factors. Basically, these are payments made to factors of production. So payments made to capital plus payment made to labor. So if you add payments made to capital and labor, in total, they sum up to total factor payments. Total factor payments are actually costs of value added. So the price of output, or just price of value added, times value added, PY times Y is equal to total factor payments, which means the production, in the production process, factor payments make up all the cost. This is equivalent to saying zero profit condition. So there are no profits. This is a characteristic of competitive markets. If you remember from your economics knowledge, in microeconomics, the competitive markets have zero profit condition. Zero profit means that all costs are covered and there's no profit on top of that. Remember, the costs here are capital and labor costs. On top of that, there's no profit left to the firm. There's no economic profit left to the firm. So we might wonder, so is this really reliable? Because the profit you have in your mind is the payment to capital. Because payment to capital, as we named it, a gross operating surplus or profit in general, is the share of the capitalist or capital owner. In this case, workers are paid wages and capital owners are paid rents. So the PH values are prices of capital and prices of capital and price of labor. So if H is capital, then P capital means rate of return to capital. This is payment made to capital owners. And in your mind, probably you're thinking of profit as something like that. Profit is the part of the revenues from production that goes to the owners of capital. So owner of capital in this case can be the owner of the firm, managers, or even stockholders. So basically, what we mean by zero economic profits is that nothing on top of that. So you pay to labor, you pay to capital, and that's it. So zero profit condition is shown in algebraic form with the last equation you see here. That's why it is very important. We need to ensure that this zero perfect condition holds. That's why we have this equilibrium equation at the end. That's all for the Cobb-Douglas production function. In the next slide, we will look at the intermediate inputs, how we handle intermediate inputs in the CGE model. At the second stage of nested production, we have a Leontief production function between intermediate inputs and value added. Here you see the intermediate inputs on the vertical axis and the value added on the horizontal axis. And the production function between these two, remember the value added production function is the Cobb-Douglas production function for between capital and labor. So this now appears as value added in the horizontal axis. So the Leontief function is named after Vasily Leontief, the Russian-born American economist who is famous for developing input-output analysis and input-output tables about 100 years ago. So the Leontief function looks like what you see on the graph on the left. So there are two lines here which are kinked, named as Q1 and Q2. Such lines are usually called isoquants, but it comes from macroeconomics. Okay, for now we will just call it production functions. So as you see, they are straight lines with a constant slope. So what we mean by this kind of Leontief function is that there are two inputs here, value added, which is capital labor, combined, which is aggregated, and intermediate inputs from other sectors. Actually, there are so many intermediate inputs, but we just made them, we just represented them as X, just like just as if they are one input. So basically, what we see here is these intermediate inputs and value added are combined in as constant shares of production. So when you have constant shares of production, basically that means 2 units of value added, 1 unit of intermediate inputs. So that means the slope is constant. If you move up up to the right and upwards, the output is going to be higher, which is Q2 is greater than Q1. But no matter how much you output, you produce more or less, doesn't matter. You're using value added and intermediate inputs in fixed proportions. So if the slope is 2, that means for each 2 units of intermediate inputs, you're using only 1 value added input. So this is the meaning of Leontief function. There is no substitution. So you cannot just say that I'm going to use more value added and less intermediate input. No, you cannot say that. There is no substitution because it is already coming in fixed proportions, 2 to 1 or any other slope. So well, this is very convenient in a way because the intermediate inputs here are coming from different industries, from milk, from bread in our case, but you could have 100 industries as well. In that case, you might, if you have a production function like Cobb-Douglas production function, your production function is going to look very complicated then. Having a Leontief function this way with no substitution, fixed coefficients, well, basically it's called linear technology. If we have this kind of a fixed coefficient, fixed proportion production pattern, then the calculations are going to be much more simple. And this is why we prefer Leontief functions for intermediate inputs. Okay, as to intermediate inputs, in itself, they are also used in, so we have on the X, you see in the vertical axis here, but the X is a combination of intermediate inputs from different sectors, from two sectors, in our case, bread and milk. For the intermediate inputs, we also assume there is a Gaussian function in itself. So these intermediate inputs are used in fixed proportions, as fixed coefficients, and these are shown here. As you see, xij is equal to a xij times zj. So xij, x is the here x is the amount of intermediate input used in the production of good I, but the inputs are coming from sector J. So xij means that the inputs, intermediate input J employed by the industry I. So this is the Leontief function here. We have two variables here, z. Z means the total output. So x and y. X, remember intermediate inputs. Y is value added, the Cobb-Douglas function. When we combine these two, when we aggregate them using this Leontief function, which looks like this shape, like in this figure, then the output, the resulting output, we will name it Z. So Zj is the output of sector J. And in the SAM, output of sector J is output of bread and output of milk are coming from the relevant column sums of bread and milk columns. Okay, so now we have made it clear that Leontief function is explaining the use of intermediate inputs in our CGE model. So another thing here is a, small a. Small a is basically a coefficient. Remember, these are fixed coefficients because we are using every input in fixed proportions. These are the fixed coefficients showing input requirements. Okay, so a xij, for example, ax means the input requirement, so intermediate input requirement. Ij are the industries, so that means ax sub ij means the intermediate input requirement coefficient for the sector I for intermediate input used from sector J. Okay, so this is important for us. And just like in production function, Cobb-Douglas production function, for the Leontief function too, we have first order conditions. Every time we're talking about first order conditions, we are talking about an optimization problem. Optimization problem is either a maximization or minimization problem. For production, maximization problem, because we, as producers, we want to maximize our profits. But in the end, it's a competitive market, profits are going to be zero. So, which makes it even much easier for us, because when taking derivative, it makes it easier for us. Okay, so next slide, we're going to talk about the first order conditions for the Leontief function. Leontief function also has its own first order conditions, and here we want to solve a maximization problem. The firm here wants to maximize profits, and profits are revenues minus costs. Basically, now we have revenue of the firm is total sales. Total sales is the value of output in this case, which is P times Z, as you see on the maximization problem. We are maximizing here. You can see at the bottom of this left bottom of the slide here. We are maximizing pi j. So what you see under the maximize term here is z, y, and xij terms. So these are the variables x, I, j, y, j, and z, j. These are the terms we want to take derivative. Okay, so we will take derivative of this maximization problem. We want to take derivative of pi j with respect to xij, yj, and zj, and equate them to 0 to find the optimal amount of z, y, and x terms. Okay, so just like every optimization problem, we have a constraint. Okay, let's get back to the profit function here. Our profit is revenue minus cost. So revenues are uh, PZ times Z, which is the first on the right-hand side of this maximization problem. And this is the first term on the right-hand side. So total revenues minus the cost. The costs are coming from two sources here. Remember, we have in the Leontief production function, we have intermediate inputs and we have value added. Value added is basically the cost of capital and labor. So we did it before in the Computable production function. We already have y from there, and we multiply that with its price, which is the price of value added. Then we get py times yj. This is the first term in brackets here, plus there's an operator, sigma operator, is the sum operator, and you see inside that operator pi with superscript q times xij. So what do we see here? With this summation, xij are basically intermediate inputs, and they're multiplied by the respective prices of these goods, and basically what we have here is uh, the cost of total intermediate inputs. So all in all, we say that the cost of production here is the cost of um, value added, the cost of capital and labor together, which is the first term in brackets, and then the other cost item is the costs of using intermediate inputs from other sectors, and that is the second term in brackets. Okay, now we are ready to calculate the profits. The profits are now equal to the first line here is the maximization problem. Our constraint is we want to minimize these costs, and so we have a cost function here. What you see here is zj is equal to min and the term in brackets there. That is basically the Leontief production function. So you have now, because we have only two sectors, bread and milk, we have total intermediate inputs used in bread, total intermediate inputs used in milk, and we also have the value added. So here we have the Leontief production function in the second line. That is our constraint. Okay, so we solve these equations. I'm not going to go into details of these again, but when you solve, you will get optimal amounts of z, y, and x variables here in the Leontief function. So you will see them in calculated form under the optimization problem. Next, we look at the Armington function. The Armington function is basically looking at the demand side of the economy, where the households are combining domestic goods and imported goods, and they're consuming these two. So, because now the economy is an open economy, the consumers are now have the option of choosing between imported and domestic goods. These are, remember, for the same type of goods. So we have two sectors here, bread and milk. Say, for example, milk. In the case of milk industry, so the Armington function says that the consumers now have the option of either consuming the imported milk or domestically produced milk. So while this is the demand side approach, one other way to see that, as the textbook does, is to think of this as from the producer's point of view. So let's see what the textbook says about this. This is page 98. If you look at that, you see that the representative producer in this milk industry, for example, in any industry, by the way, the producers are basically taking imported goods and domestic goods and put their label on these goods and sell in the market. So basically, using these two different kinds of goods, well, the quality, the taste might be different. So there may be many reasons why one firm is selling both domestically produced and imported goods of the same kind. But whatever the reason, now we have this option. So what we observe here is now the firm has this opportunity too. So we call this an aggregation of domestic goods and imported goods. Now there's an we said that there's an option to choose between um, domestic and imported goods. So, but on what basis and how do we choose between these two? So we need a reason for choosing imported goods to domestically produced goods. So if you look at the Armington function here in the mathematical formulation has um, a lot of terms actually. The one in brackets and outside the brackets it multiplied by gamma I, which is the shift factor. Gamma is the shift factor, but M and D are import and domestic goods. And you see there's an exponent attached to these two. We call it eta I. So this Greek letter eta I, which appears as the exponent and also it appears in the exponent of the big bracket in the inverse form, you see that this is what we call an elasticity. We call this an elasticity of substitution. Elasticity of substitution is basically used a lot in microeconomic theory, and it says something about well, why we choose one M or D in this case to the other. So the meaning of elasticity of substitution, you might want to just refer to one macroeconomics textbook if you want. The meaning of elasticity, which we don't present here, is it's basically a ratio. The ratio of the the elasticity of substitution is the ratio of the ratio of two products divided by the ratio of their prices. Actually, to be more specific, elasticity of substitution is the percentage change in the ratio of M to D divided by the percentage change in the price of M over price of D. So this is basically the percentage changes in quantities divided by relative quantities divided by percentage change in relative prices. So it shows you one thing. So if the relative price of one of these products is increasing, you probably expect the consumers to switch to the other product because now they have a substitution possibility. So that means, well, if the elasticity is big, then probably if the elasticity is big, then it is going to be easier for consumers to substitute one good for the other. So and on the other side, if you say that elasticity is small, elasticity of substitution is small, then it is relatively difficult to change to substitute one good for the other. So these are shown in geometric form in the figure here, and in the arithmetic form in the equation on the slide. So we call this Armington function because it is named after Paul Armington, an economist in IMF, who wrote about this in 1969 in an article. So the the key point here is the elasticity of substitution. Here we assume it is constant. So constant elasticity of substitution, or in short, CES, is what we call an Armington function. So the implication of this thing is CES Armington function is that domestic goods and imports are not perfect substitutes, are imperfect substitutes. So where you can uh, substitute one for another when the relative prices are changing. So when we say relative prices, we mean PD over PM. So PD over PM is the slope of this line you see here, dashed line. The slope is the relative prices, and the quantities are M and D. Um, so basically now we have a consumer, or actually you can think of it from the producer point of view as well as in the textbook. So we have now problem of a maximization problem here again, and the constraint is going to be the relative prices. So looking at the relative prices, we decide how much M and how much D to choose. So this is our problem for Armington function. So if you look at this graph again, you will see that it is of a curve shape. The curved shape is basically because of the elasticity. So there are a couple of possibilities for elasticity. For example, if the elasticity is if the elasticity is 0, which means you cannot substitute one good for the other. Actually, we just saw in Leontief function. Then the shape of the what we call isochronal, the shape of this curve is going to look like a kinked shape with two lines kinked. So that was the Leontief function. The alternative is well, that is one extreme. The alternative is elasticity is equal to 1. So if the elasticity is equal to 1, then you end up with the Cobb-Douglas production function. So the Cobb-Douglas production function and Leontief production function are two extreme cases of CES functions. So every production function in economics can be shown in the form of a CES function, but the general form here is shown in this equation. So the eta, the elasticity of substitution, which appears 3 times in this equation here, is a very important parameter for us, and we derive it from the as you see in the GAMS, we derive it from the SAM. Actually, we don't know these figures from the beginning. What we do in most cases, we assume a number for this. So we can do maybe an empirical work. I mean, we can gather data, and we can estimate these using data on domestic goods imports. Some people do that. They sometimes estimate using econometric methods. So, but most often they are they find similar values. So in the Armington function, if you look at the well, if you look at the the CG model in GAMS, we sometimes assume a constant number. Well, a good number is 2. So sometimes we assume that 2, which means when the price of domestic products, when the price of domestic goods product, or here in this case, if it's the milk industry, so a constant elasticity of 2 means that if the price of domestically produced milk increases by 1% relative to the imported milk, then the quantity of domestically sold milk is going to decrease by 2% relative to imports, which means imports are going to increase by 2 times more than the 1% increase in the price. So of course, when the price of good increases, you expect its quantity in the market to decrease because there's consumers will switch to the other product, and the elasticity of substitution tells you what that is. So we assume it is constant, which means it doesn't change over time. So you may be working on a dynamic model where you make this kind of CGE model estimations like maybe over 20 years, which is possible. You may change the base year all the time, and you can do that. So a constant elasticity substitution says that this elasticity does not change over time. So we will look at the first of the conditions late in the next slide. The first of the conditions of this problem, the maximization problem, we will see later. The CS production function gives you how much M and how much D result in, and also the prices. So let's look at the next slide for first order conditions. So every time we look at the behavior of our actors in this economy, the actors are firms, households, government, producers, consumers. So these are all facing a maximization problem or minimization problem. So what they do is they look at these this problem. First we specify this problem, and then we write the constraint. So here the problem consumers are facing here is they want to they want to maximize their consumption of domestic goods and imported goods, because this is one important aspect of welfare. So consumers want to be able to spend more, consume more, so that their welfare is going to increase. And on the firm's point of view, on the other hand, they want to maximize profits, because these are imported goods and domestic goods are sold in the market by the firms. So what the firms do is they subtract the cost of imports and the cost of domestic goods. So the cost of imports are PM, which is the price of imports, times the 1 plus T. T is tau. Tau is the tariff rate, because imports are coming with a tax too. That is the first term on the bracket on the right hand side, and in the bracket on the right hand side, and then there's the second term, PD times DI, so which is the price of domestic good times the D. So this is basically the value of the goods sold in domestic market, domestic good and imported goods. So we subtract this from the value of output, so that gives you the total profit for the firm, and then the constraint here is the constant elasticity of substitution CS production function, or the Armington production function. Okay, so basically we calculate the elastic substitution using the parameter, elasticity parameter here. So we talked about the parameter. The elasticity of substitution is basically is not equal to eta, is equal to what we see in the if you look at the right hand side, the right side of the slide, you will see the at the bottom of the glossary, you will see how it is calculated. So the relevant term you see there is sigma. Sigma is the Greek letter at the end. This is the elasticity of substitution, and this is how we calculate it. You can see that. And to calculate sigma, we need to know eta, which is right above the elasticity of substitution. We do this in GAMS. So the Armington function is a composite function. Composite function means that so when we have aggregate goods, domestic and imported goods, then we call this the sum of these two goods sold in the market. We treat them as single products, such as if you're talking about milk industry, the Armington composite good means imported milk plus domestic milk. So it is basically just milk. So for the firm, we differentiate between the origin, domestic or import, but we still treat it as a single product. So that means a composite good. Okay, so that's why we call this composite goods. We have two composite goods, bread and milk. From the both demand and supply sides, we call it composite good. Okay, so this is the maximization problem. So what we do is we take the first derivatives, and first derivative with respect to Q, M, and D, and that's how we get total or optimal levels of output, M, which is important, and D, which is domestic goods. And when we calculate that, remember that in the equations we have prices, PM and PD, and they show up also in the first order conditions. So the first order conditions are written at the bottom of the slide. You will see that in the in GAMS we write them as ratios. For example, the first order conditions say that MI is a multiplication of one term plus times QI. Basically, we write this as MI over QI is equal to the term in brackets. And similarly for DI, QI, we write it as DI over QI. So that's how we calculate the first order conditions. After the first order conditions, we get optimal amounts. And accordingly, we also get the relation between these quantities M, Q, D, and the relative prices, which are PM and PD. Remember PM and PD, these are the relative price ratio. This is the dashed line whose slope is important for us to calculate the optimal amounts of QM, QM and D. Okay, so that's okay, that's all for the domestic good import composite good, Hamilton function. So next we're going to look at the other side of the production, which is another problem for the producers, which is the relation between exports and domestic goods. Okay, here we have the domestic goods and exports function. We call it the CET aggregation function. CET means constant elasticity of transformation, which means the producers are transforming the gross output, which is basically denoted as Z in our case. The gross output. Gross output is actually equal to the sum of domestic and exported goods. So what the firm does here is well, there is just like the CES production function, we have a CET, constant elasticity of transformation. Just like the CES Armington function, we have a firm here which aggregates or just combines domestic goods and exported goods. So sometimes firms are producing for different markets. When they produce for the domestic market, they have some specifications of the product, and when they produce for the export market, they are maybe differentiating it a little. I look at the case of Japanese cars they sell in Japan, Japanese cars they sell in foreign markets. For example, one thing that I found very interesting was that when I came to Japan, I just thought that these cars in Japan are very small. But that's because if you look at the roads in Japan, how small they are, and maybe the Japanese consumers, maybe how small they want their cars to be. So, well, basically, they don't need big cars in Japan. And I think consider the space considerations as well. So, but in foreign markets, they want bigger cars, especially in America. So, that means the firms in Japan are going to produce two different kinds of products, but for the same product. So same for bread and milk industries in our case. Now you see that we have here a CET aggregation function. If you look at the CET aggregation function, you will see that there will be exports and domestic goods on the axis, and what you see there is something like the CES production, so CES Armington function. We have we have relative prices of exports and domestic goods, and we have the relative prices and quantities on the axis. So the relative prices are shown by the slope of the line. We call this the budget line, which I will explain in the next slide. So the problem of the firm here is, well, this is the actual final stage of the production function. In the if you look at, if you remember the big structure of the general picture of the model at the beginning of this of these lecture notes, This is the final stage, right? So um, now the firm is deciding whether to sell the product domestically or in export markets. So again, the firm will look at the ratio of quantities to the ratio of prices, or basically elasticity of transformation. So elasticity, again, here denotes the percentage, the ratio of the percentage change in relative exports, relative to domestic products in this case, divided by the relative price of exports, which is the price of exports divided by price of imports. So this is again very important for us, and the elasticity of substitution in this case, or elasticity of, now we don't call it substitution, we call it transformation, because substitution is for the consumption side. Here we're talking about transforming products to D or E in this case. All right. So when you look at the graph here, you see that the relative price line is intersecting the aggregation function, CET aggregation function, the solid line at the point. So where they meet, where these two lines meet, the curve and the line meets, we get the optimal amounts of domestic goods, exports, and also the relative price ratios, PE and PM. This is very similar to what we did in the CES production function. And the elasticity of transformation, again, here is very important because it determines the curvature of the curve here. So it can range from 0 to a very high number. When it is 1, it looks very much like the complex production function. When it is 0, like a Leontief production function. Here we assume that it is a constant number. And again, we just assume it is a constant number. And we just think that basically um, it doesn't change over time. So now we have the firm is going to maximize profits again with respect to now this the CET aggregation function and its profits, which we will do in the next slide. Here is the maximization problem of the firm. The firm maximizes the profits, which are defined as the total value of exports and domestic goods minus the value of output. So basically this is equal to PE times E plus PD times D, which is the first item on the in brackets on the right hand side after the maximization of profits. So maximize PI is okay minus the price of basically outputs, gross outputs. You see that it's 1 plus tau z times p times p z times z. So tau z is here the taxes on production. So we call it indirect taxes on production. So basically we are subtracting the tax inclusive values of gross output from the total value of export in domestic products here, and the constraint here is the CET production function. So we have the elasticity of transformation explained in the last two lines of the explanation where you see the terms. And now what we do is just like in the CES Armington function, we take the first derivative and then equate them to 0. Take the first derivative with respect to z, e, and d, and you see that we have the two conditions, which is written at the bottom of the slide. So we can calculate the ratio of e to z and the ratio of d to z using these two equations. This is what we do in the GAMS. So and from here we get optimal amounts of e, z, and d, plus the PE and PD as well, plus PZ. So having done all these, now we have an understanding of the behavior of the firms and behavior of households in a way. So you may find the CES and CET functions a bit annoying because of the maths, But one thing good about this is, first of all, the CES and CET aggregation functions and the first order conditions you see here are very useful because they connect so many things in the model. Price of exports, price of imports, price of output, price of domestic goods, price of imports. So all of these, they are now connected using these equations. And now that we know how to write these in GAMS, when there is a missing link in a system of equations, and you cannot solve it. So these first order conditions are actually providing us those links. So we can now solve different equations and link them together through these common terms like PE, PD, because these PE, PD also appear in other equations as well, as we will see later. And using those and some other constraints which are required for equilibrium in the markets, we can calculate the general equilibrium. So good thing about the CES and CET functions plus Leontief and also Coplagdus too. All these equations, all these production functions, etc., you saw up to this point are standard. And once you learn, once you know what they mean, actually you don't even have to know the details. These have become the standard, right? So, but just like there are so many formulas in statistics that you don't have to know the details if you know the meaning of them. When you see, for example, the standard deviation or average or those. So even if you don't know how to calculate all those, if you know the meaning of them, which are very important for you, then there's no problem. Just like that, you know the meanings of these equations, and these appear in the same way in any CG model or any CG study you see in any journal. You don't. They usually don't talk about these details. Actually, no, not many of these papers you see using CG even mention the equations here because they have become standard. And so what you will do is write these in your own model, and anytime you want to run a CG model to do any kind of policy analysis, just use the same equations. You may want to use different alphabet characters of the alphabet, letters of the alphabet instead of the E, D, G. You might want to use different characters. It's okay, but basically the equations you're going to write are going to look exactly like this, and there's no need to change anything. So if you're really interested in the details of all these, your textbook provides all the mathematical details. And if you're more interested, I can give you some materials to read on your own time. What I'm asking you to be able to write all these first order conditions, and these are basically what you need. You don't need to write the maximization or subject to kinds of notations here. All you need is the first order conditions, the last two equations in each of these slides here. So, but it's always good to know what they refer to, especially in terms of geometric the form as you see in the graphs. Okay, so I'm going to stop the discussion here on CES CET and uh, move on to the behavior of the households, which we will introduce the concept of utility and welfare. The next actor we're going to look at is households. So household behavior is basically formulated by looking at the utility function and its constraint. The households have utility, and the utility comes from consumption of goods. Here we have two goods, bread and milk. So if you look at bread and milk, you will see that they appear in the household's consumption utility function, which is maximized. UU is the fictitious utility level because in economics in statistics you will never get the data like this utility. It's never reported in statistics. Basically, this is welfare of the society, and we assume that the welfare is coming from the consumption. So when more is consumed by households, then their welfare is going to increase, and so utility is going to increase. Here we have x to the power something like alpha I. Okay, so basically this is a Cobb-Douglas utility function. Cobb-Douglas utility function looks like Cobb-Douglas production function. You remember its shape is very similar. And in geometric, it looks like the graph here. The kinds of utility functions we see in this is curves here they are called indifference curves. This is coming from the macroeconomic theory, and here the indifference curve belongs to the society, basically households here. So what the households want to do is they want to maximize the utility. So when they do that, remember the elasticity of substitution. They can substitute between bread and milk by looking at the prices of these. If you look at that, you will see that the Cobb-Douglas production function already says that the elasticity of substitution is equal to 1, which means when there's a 1% increase in the price of milk, for example, then the households change their consumption. Now milk is more expensive relative to bread, so they switch to bread, something like that, and it is 1 to 1. So when there's a 1% increase, 1% increase in the price of milk relative to bread, and then they decrease their consumption of milk, and they increase their consumption of bread by 1%. So that's the meaning of Cobb-Douglas production function, and because it is a constant elasticity again, it has a curved shape like this. So the constraint we have here is reported in the subjective part, and you see that the households constraint here is, we call it budget line, by the way. This is the dashed line, and the intersection point, which is denoted as Y here, it gives you the optimum amounts of milk and bread, or optimal consumption of bread and milk of the household. So the households, of course, want to consume maximum of bread and milk, but they're constrained by their income. So where did this income come from? Basically, households' income are coming from their factors of production. Remember, households own both labor and capital, so they are paid rent or profits for the use of capital, and they are paid wages for their labor. So the sum of these two are actually, if you look at the subject to or the constraint part, you will see that these on the right hand side in the summation form, this is PF times FF. So these are factor payments to households, basically, which means wages plus profits minus savings minus taxes paid to the government. So basically, this is basically the disposable income of the households. Household disposable income, less of tax, less of savings. This is total household income which is available for consumption, and this is equal to the total value of consumption, which is on the left hand side of the equation, the constraint. So it is sigma PQ times XP. So XP is consumption and PQ is the price of consumption. So remember, every time we're talking about a quantity, for example, consumption, in consumption and value added, intermediate input, import, export, all these are coming from their own prices, and they are coming with their own prices, and so their prices do not have to be the same. So price of consumption might be different than price of imports, price of exports, which usually are the case. So then we have to basically, when we calculate, when we denote values, remember a value is equal to price times quantity, which often show up in the equations here. So again, now we have this household trying to maximize utility with this constraint. What we do is we take derivative of the maximization utility function, a Cobb-Douglas utility function, with respect to xp, because that's the only item appearing in the equation, in the formula. So we take derivative of function with respect to xp, and then we calculate the optimal amounts of bread and milk. And when we do that, we are also using the constraint as well. We also calculate the consumption consumption, price of consumption as well. So remember that in the solution, which is the last in the last line of the slide, the solution, which is what we insert in the model in GAMS, shows a relationship between the price of consumption, quantity of consumption, income, savings, and taxes. Basically, this is a demand function, because the demand function, remember, demand function is a relationship between quantity and prices. That's what you get here. XP is quantity, PQ is prices. And also, what is different in general equilibrium is that in a demand supply model, you see only PQ and XP. That's it. P and XP. Nothing else. But here we see that the household demand function is also, it also depends on factor payments, which are wages and profits, plus savings in a negative form, and taxes too. So, the term in brackets shows the disposable income of the household. So, household demand function in our case is very much different than the, or at least updated compared to the demand function, as you know from microeconomics. Okay, so GAMS does all these calculations for us. We don't have to calculate all these by hand, but what we know is that once we specify our Computable utility function, then we get the utility. Utility is also our ultimate aim of our model, CGE model. We want to maximize utility. Because any economic policy, its aim is to increase welfare of the society. Here we define welfare, social welfare, as utility, which is U. Okay, so you will see at the end of the model that we are going to maximize this when we write the programming code. Okay, now next we're going to look at the behavior of the government. We have to define the behavior of all economic actors because we are talking about the circular flow diagram, and the government is part of the diagram. Government is an important actor in the economy. So just to make sure that we don't have any missing link in our CGE model, we specify the equations related to the behavior of the government, which are shown on the right-hand side of the slide. So if you look at this slide, you see here on the right side, you see the 4 equations on the top. The first equation is the first 3 equations are about the sources of government revenues. So government basically has 3 kinds of revenues. These are all taxes. Taxes paid by producers during the production process, we call them indirect taxes. With taxes paid by households to the government, which are something like paid paid on labor wages and paid for profits. So these are going to the government as income taxes. And tariffs which are coming from imports, because the government also charges tax on imports in the form of tariff. So these 3 make up the government's sources of revenues. Okay, what the government does is the government takes these revenues and spends on products, goods, which are bread and milk in this case, and saves part of it. Remember, the saving can be negative, so that means the government's spending might be more than its income. In this case, the government will be borrowing. And when the government borrows, we show it here in the sum as a negative government saving. Okay, so basically government saving is its budget surplus. If it's positive, it's a budget surplus. If it's negative, it's a budget deficit. And the government's budget is made up of revenues and expenditures. Okay, I think it's easier to understand here. If you look at the first equation on top, on the right, you will see this is TD is equal to tau D times something in summation form. Well, tau D is a constant tax ratio. Okay, so this tax rate is on factor income. Remember factor income, FF, multiplied by PF, which are prices. But these are the households' revenues from production factors, which is labor and capital. So basically, this means the summation of these The summation term here means the sum of payments made to labor and capital. So these are basically wages and profits. And the government is charging a tax rate tau d. The Greek letter tau here with the superscript d is the direct tax rate. So basically this is direct taxes or income taxes paid by households to the government, which is t superscript d. This is the first source of revenue for the government. The second source is what you see in the second line here, Tj with the superscript z, which is equal to tau z times the value of z, p times pz times z. Okay, so z is output, gross output. So this is tau z, which is the indirect tax rate, which is okay, these tax rates, indirect taxes, income taxes, and tariffs are all constant. These are constant. So a constant figure here means a parameter. So these Greek letters tau d, tau z, tau m, tau m for imports, which is tariffs. So these are all constant tax rates. We take them from the SAM as ratios, and it's easier to calculate. We calculate that also. If you look at the GAMS code, we will see, you can see that you have to calculate these. Previously we have defined parameters. You see these also in the parameters, and you can calculate from the SAM as simple ratios. Well, simply dividing some figures in the SAM, you can get these. Okay, so the second equation, tau z, is basically the second source of the government, which is indirect taxes. This is indirect tax ratio multiplied by the value of the gross output. So this is the second line. And now on the third line, you will see that we have import tax revenues or tariff revenues to the government. This is basically TM, that is the third equation. And if you look at that, you will see that it is multiplication of tau m, which is the constant tariff rate, multiplied by the value of imports, which is PM times M. PM is the price of imports, M is the imports. So remember, this also appears in another equation elsewhere. So this is also here another connection, which we connect now government, producers, and consumers. So imports are appearing in most of the behavior of economic actors. So this is an important link for us. So you see that the open economy has more linkages among the economic actors. Okay, now the third equation here is the last source of revenues. Now we have three sources of government revenues, and now if you look at the fourth equation, you will see that the government's spending is financed by these tax revenues. Actually, you can rewrite this equation in different form. You will see that basically xig is equal to PQ times xg is basically, PQ is the price of consumption times xg. xg is the government spending. So if you multiply government spending by the price of the relative consumption item, which in this case bread and milk, you will get total government spending. So instead of multiplying by xg, we just put it on the other side of the equation, and the fourth equation here in the denominator. So we multiply, so we divide the whole term by PQ. So what you see here is an important equation, because it says that the fourth equation here is xg is equal to mu I divided by PQ multiplied by the term in brackets. All right, so that means the TD plus total TZ and total TM. These the term in brackets is total import taxes, total indirect taxes, plus the total income taxes. These are basically the term in brackets, the total revenues of the government. You multiply that with mu I. Mu I is a constant, again a parameter. And what we assume here is that the government's composition of government spending is a constant. For example, if the government is spending 20% of its total spending is if the 20% is on bread, it is always 20% anytime, and the remaining 80% will be on the other product. So we assume that this percentage composition doesn't change. For that, we have a parameter which is mu I. Mu is the percentage share of the good I in government's total spending, and the sum of all these, of course, will be equal to 1. Which is 100%. So in the last line, you will see the government's demand function. So here xg in the fourth equation was the government spending function. But government demand is different than government spending, because what you see as government demand and government spending is that government spending is on the fourth line. It is equal to government spending is equal to total. So we can assume that the government spends all of its income on spending. But it may not be true, because the governments may be saving, right? So the savings appear in the brackets in the fifth equation, which is at the bottom. You can see government demand function. It is very similar to government spending, but here it says that government spending is equal to government spending. Total government spending is equal to government revenues minus government savings. So basically, government's disposable income. Total revenues minus savings of the government. Well, that is the total revenues, tax revenues available to the government to spend on goods. Okay, so here, don't forget now SG, which is the government spending, is in brackets, but it is also multiplied by mu, which means the government spending as a person, government savings is also a constant fraction, a constant share of total government basically government income or spending. Anyway, so we assume that government savings is kind of exogenous in this case, which means government, for example, if you have a 100 yen government income, if the government is saving 2% of it, in this case it is 2 yen, we assume that this 2% government budget surplus continues forever. So that's why we have mu I also affecting SG in this equation. So that is the government behavior. In the next slide, we will look at investment behavior and its relation with total savings. Next, we look at the investments and savings. And remember, investments and savings are also two accounts which appear in the social accounting matrix. This is important for us because from macroeconomics, we know that total savings in an economy are equal to total investments. So, well, let's look at the equations here for savings. So we have three kinds of savings which make up total savings in an economy, which are government savings, which we denote as SG, household savings, SP, and foreign savings, SF. Well, the household savings SP, P actually denotes private, so private savings mean household savings. Okay, so now we see that the here in the first equation on the top, you see that the total investments are equal to total savings. So XV here is investments, and this is divided by, this is actually multiplied by PQ, which is PQ times XV is PQ is the consumption price. So PQ times XV is equal to total the value of total investments, which is equal to lambda I times SP plus SG plus ESF. So SP is the household savings, SG is the government savings, and SF are foreign savings. Foreign savings are usually reported in terms of foreign currency. So we multiply that with the exchange rate so that we get the foreign savings in terms of
domestic currency. What you see in brackets here is SP, ESG, and SF. The sum of all these are total savings. If you multiply that with lambda I is basically the share of the good I in total investment. So basically that means a constant fraction of the savings are going to investments. So again, we assume that, for example, if we have 200 yen for savings, and now because it's 200 yen, these are all going to investments. Um, if 140 goes to bread and the remaining 60 goes to milk, which is 70% for bread and 30% for milk. We assume that this 70% and 30%, which is lambda I, are constant, which means if you double, for example, savings in this economy, then the investments are going to double. And for example, in the case of milk, just using the same numbers again, we will just be, instead of 140, it will be 280. And for the other sector, it's instead of 60, it's going to be 120. So the percentage composition will not change, while the numbers may change. So this is the first equation, which means total savings are equal to total investments. Okay, one thing important here is maybe the meaning of SF. SF is foreign savings. So here, what we mean by SF? SF is actually another term we use for current account deficit or surplus. So in the sum, if you see a positive number, which means foreigners are paying to the capital account in the sum, which means we are borrowing from abroad, or we are receiving some money from abroad, in which whatever form it is coming into the domestic economy, we get foreigners' money. So foreign savings are actually maybe most often it is for a developing economy, it is coming in the form of borrowing. And the SF here, when we talk about foreign savings, basically we are borrowing their savings, foreigner savings. So that means, well, we have to think of it as current account surplus. So here, this is important again because now we are connecting the external wing of the economy with now investment. So this is very, very important because it is an important identity in macroeconomics as well. If you remember in macroeconomics, total investments in an economy are actually total savings plus current account deficit. This is nothing more than that. Okay, and this about savings, we have two more equations. We just assume that the government is saving a constant fraction of its total revenues, which you see in the bottom equation. And on top of on top of that, you will see that the private or household savings, and households are doing something similar. They are saving a constant fraction of their total income, which their income is coming from factors here in summation form. You get PF times FF. So the SSP, which is the constant saving rate of the households, SSG, which is the constant saving rate of the government, SSG, we just assume that these are not changing. Well, actually, we call such saving rates average propensity to save. In macroeconomics, this is important. So saving rate is an important ratio. Well, actually, this is a parameter. We assume it is not changing. Remember, anything that is not changing in CGE model is a parameter, is exogenous. So we assume that SSP, SSG, these saving rates are not changing in this economy. Well, actually, it is a bit realistic because it takes a lot of time for saving rates to change in an economy. You may have very, very important, very, very good reasoning for why this is declining. In the case of Japan, for example, because the population is aging, then Japan used to be a high saving rate economy. Nowadays, its saving rate is one of the lowest in OECD countries because of the aging of the population. So over time, this may change. But for a developing economy where such changes are either very slow or just
even not existing, then we assume again it is very reasonable to assume that these constant saving rates, SSG, SSP, are just parameters, exogenous parameters. So having said that, now we have the link between saving and investments. Next, we're going to look at the external side of the economy, basically the relation between exports, imports, and their prices plus the exchange rate. Okay, let's look at the international or external side of the economy. The external side of the economy, or the CG model, deals with exports, imports, and the prices of exports and imports. Now we make the assumption of small country. A small country in international economic theory is that a country is a country which cannot actually change world prices. So world prices are given, and because it cannot affect world prices, that's also what we do in the CG model here. What you see as PWE and PWM are world prices, import prices, and export prices in terms of foreign currencies, which are actually taken as exogenous. So when this country, when the country is subject to CG model here, well, basically this is our country, our CG country. When the firms are exporting their products, they take the world prices as given. So they can sell their products and only at the world prices available in the world market. And then when they're importing from abroad, they also take the world prices of the respective product, and these are all exogenous. Okay, to convert these prices into the domestic prices, we need to multiply them with the exchange rate of the country. So this is what you see in the first two equations here. PE and PM are export and import prices in domestic prices, of course, and they are the respective export and import prices, world prices, multiplied by the exchange rate. So exchange rate is denoted as the domestic currency to foreign currency ratio. Basically, this is the in most cases, because the trade is conducted in US dollars, basically this is the exchange rate of your currency in terms of US dollars. For example, in the case of Turkey, this is equal to 6.7. In the case of Japan, this is equal to 107. So the third equation you see here is the equilibrium in the external side of the economy. So you see that it is equal to the the first item on the left hand side of the equation here is PWE times EI, which is the value of exports plus SF. SF is the current account surplus, but it may be negative. But this is basically the foreign savings, which we just covered in the last slide. Okay, so if you look at the left hand side says exports plus foreign savings, this is equal to imports. That's actually very straightforward. It's easy to understand. If you look at the equation, you can interpret this as the equation here is the interpretation is very easy. If you want to import something which is on the right hand side of the equation, then you have to have exports, right? Well, if your export revenues are not enough, you have to use foreign savings. So that means if you want to import, but your export revenues are short of the money required to buy those imports, then you have to borrow from abroad, which is SF. Okay, so don't forget that a positive SF, positive foreign savings here means current account deficit. Okay, don't forget. So if you can, we might want to put it in another way. For example, take the E export part to the other side of the equation, so that you get SF is equal to M minus E, which is equal to trade deficit, right? Imports minus export, which is equal to current account deficit or foreign savings. Okay, you can also think of it that way. Well, I think the international trade part of the model is very easy to comprehend this way. What is important here is now we have exports, imports. Remember, exports and imports are also appearing in the Armington and CET functions as well. So here is a
another equilibrium condition, so that now we have all previous equations, first order conditions. We calculated optimal amounts of E and M plus the price of exports, price of imports there. Now we are connecting, we are linking them with the equation, equilibrium condition here in the last third equation here. So which is very important for us. We are almost reaching the end. All remaining is to clarify, so specify the market equilibrium conditions. We have one or two conditions left, and that will complete our model. It's coming on in the next slide. Our model is almost complete. We need to specify only two conditions so that we can reach equilibrium in the economy. The first condition is about aggregate demand and aggregate supply. So aggregate supply is total output produced in this economy. This is shown by QJ, which is equal to XP plus XG plus XV plus the sum of Xij. So this says that total supply, which is on the left hand side, is equal to total demand, which is made up of household spending XP, household government spending XG, um, investment spending, which is XV, plus total intermediate demand, input demand, which is shown by the summation of Xij. So remember that this holds for every product. So we have two products, bread and milk. So this means this equation, the first equation on the top here, holds for bread. It also holds for milk. So we have actually two equations here, one for bread, one for milk. Okay, this is the equilibrium for the goods market. Okay, we need also an equilibrium for the factors market. So in the factor market, we have capital and labor traded. So in the goods market, we have bread and milk traded. In the factor market, we have capital and labor traded. So we need an equilibrium condition there as well, and which is shown with this simple equation you see in the second line. You on the right side, which is the summation of total FHJ is equal to FFH. So FFH is the available total available factor, which is equal to total demand for this factor over industry. So because H, the subindex H refers to either labor or capital, so this means this equation holds for both labor and capital. Actually, we have two equations again, one for capital, one for labor, which means, in a way, total capital stock in this economy is equal to demand for capital by bread industry and demand for capital by milk industry. Also same for the labor industry. So total labor available in this economy is equal to total demand for labor in bread industry plus the total demand for labor in the milk industry. So these are very straightforward. Again, this completes our equations, and now the CGE model is complete. Now after this in GAMS we will have to write these write the necessary variables and write the necessary equations. After writing the equations, we will just solve the model. That's it. Okay, so well, remember the general equilibrium condition. If we have all markets in equilibrium, then the economy in general is equilibrium. So we call it general equilibrium. So another important thing here is that all prices are actually relative prices relative to a fixed price level, which we assume to be the price of well, we fixed the price of wages in the previous case in the lecture notes number 4. So here you can do something similar, fix one of these prices. So you might want to just like in the previous model, you fix the prices of price of labor. You can do the same thing, and let's do that. Fix the price of labor, make it equal to 1. Write your model. We can just call it standard CGE and solve it by maximizing utility UU using again NLP, which is nonlinear programming. Okay, that will solve the model. So here in the next slide, slides after this, the following slides will show you how to do that in GAMS.
This slide and the following slide, these two slides show you the list of variables which you will include in the GAMS code. Actually, these are from the previous equations we have seen so far. The first column here in this table is the list of these variables as these are endogenous variables. These are the variables that the model solves for. These are appearing in the same form, in the same notation as they appear in the equations. The second column shows you how you can write them in GAMS. You can use these notations in the second column. These are basically the same things, but don't forget that these variables are defined over their sets, and the definitions of these are written on the column, the third column. So I want you to write all these, declare all these variables in GAMS so that you will be ready to put them in the in the model and then solve them. So this is the first task for you. Declare variables, and you know how to do that using GAMS code. After declaring the variables, now you have to declare the equations. And remember how to write the equations. Don't forget to put two dots after the equation name. So first, define your equations as you see on the first column. The definition of each equation is here. This slide and then the following slide, these two slides show you how to write your equations. The mathematical equations are as they appear in the model. We have been seeing all these equations so far. They're on the third column. So what you will do is to name your equations as they appear in the first column, and then write the open mathematical form as you see on the third column, as you see them here on the. You will put them as they are in GAMS. So don't forget to define your sets for equations, and don't forget to make no mistake in writing these equations. Especially look at the subsets I, J. So don't forget to put these also. Okay, so after doing that, you're ready to declare your model and solve it. The final step in CGE modeling is to define the model and solve it. So you will just write the code model standard CGE. Don't forget to put slash, and in between two slashes write all, which means they include all equations. And it's followed by a semicolon, and then solve this model which you named standard CGE, maximizing UU using an NLP, which is nonlinear programming. So we are basically maximizing utility, and this is a nonlinear programming code, and GAMS will choose the appropriate solver for us. So in this lecture, you learned now how to how to specify a CG model for the standard open economy, a standard CG model for an open economy, where there are exports, imports, there's government as well. And you learn how to put the sets, how to write the parameters, benchmark values from the SAM, how to calibrate them, which means calculating the parameters, how to write the variables, equations, and solve the model. Okay, so this is very important, because the standard CG model you can use for many purposes, and you can use this standard model for your own research in the future. All you have to do is probably maybe by modifying it for your research purposes. You might want to, for example, increase the number of sectors. You might want to maybe disaggregate the government sector into maybe local governments, central government, and that will actually make the model a bit more complicated, but the general structure is going to be the same. So you should be able to work with a more sophisticated model without changing the general structure of the CG model. So I think it's at this step, at this stage now, it's important for you to understand the CG model. There are many guides, many user guides, many nice materials on internet about how to work with more sophisticated models, such as those dealing with environment problems and etc. So I work with such models, and sometimes you need to incorporate some economic theory. For example, monopoly markets in imperfect competitive or oligopolistic markets. In that case, you are going to deal with a very different kind of a CG model, while 80% of the model will look like the standard model. But you might want to, you will have to add some complication to the model. So, well, that is a different story because at this stage you don't need that much sophistication. But if you want to do that, that is not a master's student's work. Actually, it is a PhD student's work. If you're really interested and you want to use this in maybe your future studies or so, then you first have to try to understand the standard CG model. At the master's level, this will be a very useful tool for policy analysis, which we haven't done yet. Okay, so having said this, okay, try to solve the model. If you have any made any errors, mistakes anywhere, the GAMS will tell you where you made it. So correct it, and then try to get a perfect coded GAMS GAMS file, and then try to solve and get the solution. Check your results. The next in the next lecture notes, I will show you how to do. Um, in the next in the next lecture notes, we're going to look at how to do simulations. But before simulations, we also have to look at um, some other important things which we call macro closures. So the behavior of the households, government, and firms, these are all coming from economic theory. But sometimes the structure of your economy might be equally important. For example, you may have an economy where the exchange rate is fixed, which is not fixed in our model. So exchange rate is flexible in our model, it can change. But you may be dealing with a country where the exchange rate is fixed, so you have to make some small modifications in the model. Plus, maybe you may have an economy where wages might be fixed. This also may be possible. For example, if you're living in North Korea, wages are fixed. As such, there are also such possibilities. These kind of things are called closures, macro closures. After taking a look at macro closures, I will show you how to do simulations in the general equilibrium model. The simulations are basically policy experiments. So if you want to know, for example, what happens when you abolish all tariff rates in an economy and how to interpret those, this is one beauty of the CG model, right? So you want to know the quantitative results of such policy. Hence, we named this course Quantitative Development Policy Analysis. So to do that, basically, you will have to um, you will have to do that in GAMS. So first you have to know you have to learn how to do that, and then interpret the results. Interpretation requires some economic knowledge. So I will not go into details of the macroeconomics, but I will just show you by using a very simple graph in just one slide, which will just portray the general equilibrium in a nutshell. So we can just use that graph to explain the results in simulations. So I assume that the next lecture notes are going to be maybe the last lecture notes. I may have another lecture note for you for some maybe future extensions of the models, which I'm not really planning to cover in this course.
The models I'm talking about are imperfect competition, monopoly, oligopoly, multi-country models. So you may want to work with more than one country in this case, and such things. Actually, one thing that might be interesting would be, for example, if you're interested in poverty, you can also do poverty policy analysis here in CG models, and for do policy experiments or simulation analysis using poverty, you need to maybe disaggregate the households. So you may want to disaggregate households into rural, urban, and rural poor, urban poor, rural rich, urban rich, things like that. I might also spend some time on that. So before the next lecture notes, I will also make ready some country cases, some country SAMs, so that you will be doing your project. So I want you to split into groups and then work with your friend in the same group to write the 10-term project. So uh, I will stop here and see for that's all for the standard CG model. So I think that I can say that we finished between 80 to 90% of the lecture on GAMS and the CG model.